Good morning, everyone, and welcome to the July 25th Mortgage Quality and Compliance webinar. This is Susan Milazzo with the California MBA, and I'm glad that you are joining us today. As you might know, this is a monthly webinar that we provide on a wide variety of compliance issues, and they are free of charge. Anyone is available or is invited to participate. If you were forwarded this invitation or the email to register and you would like to receive them directly in the future, you can email me at susan@cmba.com and I'll be happy to add you to our email distribution. I would like to start us off today with a message from our 2019 MCLAC sponsor, the Compliance Group. And so I will introduce Jeff Flory. Jeff, take it away.
Thank you, Susan. The Compliance Group is very, very proud to support the efforts of the California MBA, in particular to sponsor the Mortgage Quality and Compliance Committee this year. This committee is just one of the ways that Susan and her team are working very diligently to promote advocacy among its members, to provide quality education and information to better inform our industry, and to help us all connect and collaborate as we continually strive to improve our respective organizations. For those of you not aware, the Compliance Group is a nearly 20-year-old firm serving clients nationwide in three core areas: quality control as an outsourced solution for pre-funding, post-funding, and specialty audit projects; servicing QC to help you proactively monitor, identify, and address servicing compliance; and broad-based compliance-related services such as audit prep, internal audit, AML, which ironically is the subject of today's call, and federal and state-based file reviews. Our mission is to create highly engaged partners by supporting their efforts and effectively managing their compliance and quality risks. Our team of highly knowledgeable, meticulously thorough, and passionate associates are focused on creating exceptional experiences with every interaction that we have with our partners. We value working with integrity and unassailable ethical standards. We are very passionate about producing the highest quality work and exceeding the expectations our partners have. And finally, for those of you who do know us, we like to make compliance fun as well. Thanks for tuning in today. Susan, I'll turn it back to you.
Thank you, Jeff, and we appreciate the support of the Compliance Group. Now I'll turn it over to Monica McCarthy of Crosscheck Compliance, who is our committee co-chair, who will moderate today's webinar. Monica?
Great, thank you so much, Susan, and good morning or afternoon to everyone on the call. I'm Monica McCarthy. I get to serve as the chair of this committee along with Carol Carson, my co-chair, and I'm the general counsel and managing director at Crosscheck Compliance. We are very fortunate today to be getting a legal update from Michael Pfeiffer, who is up next. He is the MBA's general counsel. Michael?
Thanks, Monica. I appreciate the opportunity to do this each month. And I wanted to, the presentation today is going to be brief. I'm going to be talking about the settlement in the Equifax case that was made between the CFPB, the FTC, and Equifax. It came out on Monday. And I was thinking when I prepared this, oh, this is going to be great. We're talking about one of the bigger settlements involving privacy enforcement actions. And then yesterday, of course, settlement came out in the Facebook case for a penalty of $5 billion. The $275 million that's in the Equifax case seems like chump change compared to that. But obviously, Facebook involves a lot of other issues, and but it does indicate something about how the FTC thinks about these things. It also indicates something about how much money Facebook has to be able to come up with a $5 billion penalty. The purpose of the discussion today, though, is to focus on Equifax and to try to glean some of the lessons that the settlement documents disclose or reveal about the enforcement issues and how the CFPB and the FTC, and of course the states were involved in this as well. This was a joint effort between the CFPB, FTC, and a number of the states in the country. So I wanted to give you the background on this, and I'll spend a little bit of time on how this problem came about, because the purpose of doing this is to illustrate for you how easy it is for these privacy things to turn into a major disaster. and how much diligence is required to make sure that you're in full compliance with the privacy rules. So, Susan, if you could just go to the next slide, I'd appreciate it. In this particular case, as revealed by the consent order, or the stipulation for a consent order, it hasn't been approved yet by the Federal District Court in Georgia, but these kinds of things are normally rubber stamped. As disclosed in the stipulation and in the complaint, basically Equifax failed to patch its network after being alerted in March 2017 to a critical vulnerability affecting its what's called its ACIS database. That database handled inquiries from consumers about their personal credit data, and according to the complaint, the ACIS portal is the doorway that was used when consumers disputed issues on their credit report or otherwise transacted business with Equifax, including requesting free credit reports and credit freezes and that sort of thing. But to do that, as many of you may have already experienced personally, the consumer must first submit personally sensitive identifiable information, I call it PII, including the name, birth date, social security number, credit card numbers, that sort of thing. And it's all stored in databases connected to this ACIS database. And according to the documents, in 2016, 25 million consumers had interacted with that database every year. So in March of 2017, the U.S. Computer Emergency Readiness Team had alerted Equifax to a new critical security vulnerability, and that's identified there as 2017 CVE 5638, found in a piece of software called Apache Struts, which was a framework used to build Java applications. And this ACIS framework, which was a legacy system apparently at Equifax that was built in the 1980s, and they've been patching it and holding it together with duct tape since then, had a vulnerable version of Apache Struts. But even though their security team ordered that the systems be patched within 48 hours after receiving the alert, Equifax did not follow up to make sure that order was carried out. And according to paragraph 16 of the complaint, the complaint is always valuable to get the details of these things. Complaint 16 says, the team issued an order to patch all vulnerable systems within 48 hours via mass email for the 400 employees, but failed to include the one employee responsible for maintaining the dispute portal on the mass email. Such an easy mistake to make. Next slide, Susan. So in paragraph 17 of the complaint, they said that they also performed an automated vulnerability scan to search for instances where this Apache Struts had remained on their network. They used a scanner that was not configured correctly to search all of their potentially vulnerable assets, and it didn't identify the systems actually vulnerable to the software flaw, and it remained unpatched. Again, they relied on an automated solution exclusively and didn't configure it properly. Again, another easy mistake to make. And I'm sure there's people out there who work with these people in the audience today that work with systems who understand that, gee, how easily these things can happen. And as compliance professionals, I think it's really important to be aware of exactly how these kinds of things can occur. So easy for some tiny little flaw or defect in the software or the things that we put ultimate faith into to go wrong. So they didn't discover this database was unpatched until July of 2017. Remember, they discovered the vulnerability in March. They didn't actually discover that it was unpatched until July. So those months went by. And during that time period, what their investigation revealed was that the hackers were able to exploit the vulnerability, get to an unsecured file that included administrative credentials stored in plain text, and then allowed the hackers to gain access to huge amounts of data, 147 million names and dates of birth, 145 million social security numbers, 99 million physical addresses, 20 plus million telephone numbers, etc., and including payment card numbers and expiration dates. All the kind of stuff that that everybody knows is private information and tries to protect, and but isn't able to do so. In paragraph 20, the complaint says that during the months they were able to operate undetected on their network, hackers ran 10,000 inquiries on their databases, specifically designed to identify personal information. So basically, what Equifax failed to do was to implement a policy to ensure that security vulnerabilities were patched, failed to segment its database service to block access to other parts of the network once the database was breached, failed to install robust intrusion detection protections for its legacy databases, stored network credentials and passwords in plain text, and relied on automated vulnerability scanners without other compensating controls to make sure that they were getting what they needed to get done. Next slide. And the irony of it, and basically the hook that allowed the FTC and the CFPB to get them, was that their privacy policy at the time stated that they had limited access to consumers' personal information and had implemented reasonable physical, technical, and procedural safeguards to protect consumer data. So they used that policy statement to basically say, you've engaged in unfair and deceptive business practice. And so they went after them under the FTC Act's prohibitions on UDAP, Gramm-Leach-Bliley's safeguards rule, and the UDAP provisions of the Consumer Financial Protection Act, Dodd-Frank, and came up with this. And Equifax, I think, wisely entered into this stipulation to pay $300 million into a fund that's supposed to provide consumers with credit monitoring services and compensate consumers who bought credit or identity monitoring services from Equifax and paid out other out-of-pocket expenses as a result of the data breach. So just keep in mind, Equifax did this data breach and then it sold customers products to try to correct the problems that Equifax itself had created. And they're supposed to add, they've committed to add another $125 million if the initial payment is not enough to compensate for all the losses. And starting in 2020, all U.S. consumers, including everybody on this call, is entitled to 6 free credit reports each year for 7 years, in addition to the 1 free annual credit report that Equifax and other 2 nationwide agencies are currently providing. Everybody knows about the 1 free credit report that you're entitled to, but under this, you get a lot more. So finally, the payments, $175 million to the 48 states, that's the penalty, $100 million to the CFPB, nice round number, and then comprehensive information security program, and I kind of list all the things. They're the typical sort of things that basically, once they get their hooks into you, then you're required to answer all their questions and create a much more robust monitoring system and report to the regulators on a regular basis. You know, a designation of an employee to oversee the program so that they have somebody that can answer to this and they can hold accountable for it, including criminal violation, conduct annual assessments, obtain annual certifications from the board of directors or a relevant subcommittee. Attesting, that word attesting is the key thing here. Obviously, nobody wants to be the person signing that attestation. Sometimes you have no choice, but that's how they go after the individual managers or board of director members. Test and monitor the effectiveness of safeguards, ensure that service providers access to the personal information stored by Equifax also implicate adequate safeguards. As I put in parentheses, this is a vendor management issue. It's something that all of us need to be concerned about. We need to be watching all the time on these privacy issues. Obtain third-party assessments of its information security program every 2 years, and back that up with the sampling and employee interviews and the document reviews that are undertaken by the assessors. Finally, provide annual updates to the FTC about the status of the consumer claims process, and they encourage employees to basically whistleblow if they find any violations of this. So again, this is subject to the final approval of the Federal District Court in the Northern District of Georgia. I don't expect any changes on that. This is going to be the final resolution of this, and is an object lesson for everyone about privacy and how to protect consumer privacy. Leads into the AML issues that we're going to be discussing today, because monitoring that kind of stuff is linked to the privacy protections, and also provide some insight into where the industry is going with respect to the California Consumer Privacy Act, which has been under legislative review this year. So that's my report, Monica and Susan. And if anybody has any questions, I'll answer them at the end.
Great. Thank you so much, Michael. We appreciate that in-depth update. And now we are going to turn next to our main program on Bank Secrecy Act and money laundering. And I have the pleasure of introducing our two speakers. First up, we have Robyn Holyoak. She is the Executive Vice President and Chief Operating Officer at the Compliance Group. Robyn brings 30 years experience in the financial industry to the Compliance Group with specific emphasis in regulatory compliance, banking operations, and legal administration. As COO, she's responsible for overseeing the daily operations of the company and has developed numerous audit platforms, processes, and procedures within the compliance and servicing departments. Robyn also served as the Director of Compliance for the company and has managed staff through successful compliance and servicing projects over the last several years. Prior employment for Robyn includes managing the legal operations staff for a mortgage lender and servicer, as well as providing technical resources to the internal compliance and licensing departments. She's also managed federal and multi-state regulatory compliance and licensing for several mortgage companies and served as a corporate paralegal and legal investigator for private firms. And Robyn has also held various management positions in banking operations for sizable savings and loan associations. Robyn is a compliance and servicing subject matter expert, as you can see, and is also a frequent speaker at various industry and servicing conferences and events, and we're thrilled to have her. Joining her today is Pamela Fleckser. Pam is Director of Internal Audit and Risk Management for Paramount Equity Mortgage that does business as Loanpal. Pam has been in the mortgage industry for over 25 years with experience in all aspects of loan manufacturing with a focus on compliance, internal audit, fraud detection, and quality control. She's developed and managed the QC and internal audit departments for several mortgage companies, where she was also the main contact for the external audits, including the agencies, California DBO, and the CFPB. At Loanpal, she manages the internal audit program, fraud, and risk management areas, and is the chair of the fraud committee. Pam is a longtime member of the Association of Certified Fraud Examiners and the creator of Insight Beyond the 1003, a comprehensive quality control plan. She is a member of our CMBA Mortgage Quality Assurance and Compliance Committee, and she's been a presenter at our regulatory conferences. And Pam is also a member of the Institute of Internal Audit. So we have two very knowledgeable speakers today on the AML topic, and I will turn it over to them at this point. We will permit you to post questions that will be taken at the end of the presentation. So feel free to do that. Susan, did you want to add anything else with regard to how to submit questions?
Yeah, there's a questions dialog box on the right-hand side of your screen, and as Monica had indicated, at any point during the presentation, you can type in your question, and at the conclusion of the presentation, we'll moderate those questions back to Pamela and Robyn.
Great, thanks. So we're going to turn it over to you, Robyn and Pam.
Good morning and afternoon for some of those that are in the afternoon time zone. We would like to thank the CMBA for the opportunity today of speaking with you and sharing some information on the BSA and AML requirements, and hoping to give you some inside information on some of the facts that you may not be aware of, on some fun facts and maybe some information that we run across that might help you strengthen your internal programs. I'd also like to thank our co-presenters co-presenter, Pamela Fleckser from Loanpal, who's very, very knowledgeable in this area. And I know she has a lot of good insight and information to share with you as well. So Pamela, thank you. We appreciate your willingness to help partner with us today. Before we start, I thought I would lighten the mood for just a minute and share maybe a funny reflection on the compliance individuals. You know, I went looking for some funny material, kind of some jokes to lighten the mood here, because what we're going to talk about is pretty serious stuff. And apparently we're not that funny. Our industry, I guess compliance people are not that funny because there's not a lot of information, not a lot of jokes out there. But I did find something that was kind of cute, and so I thought I'd share it with you guys. You might be a compliance professional if your spouse is sick of hearing about QM and ATR. At sporting events, you root for the referees. Is your SAR filed with FinCEN? You're darn right it is. At family game night, the board game Risk is banned. You're working on automating the breakfast process. If a paint can says put on 2 coats, you wear 2 jackets when applying it just in case. Yeah, I'm cracking myself up. You admire the Roomba's proactiveness, and your backups are backed up. You can have a whole conversation in acronyms: CHARM, ECOA, AML, BSA, ITF, CIP, FTC, EFTA, TILA, RESPA, etc. And last but not least, you're not creeping on your kid's Facebook page. You're just conducting, quote, risk management. And I thought that was kind of cute to kind of lighten the mood. And now we have to move on to like the serious subject matter. So let's get started. Okay, a quick disclaimer. This is just our legal jargon here. We're not a law firm, neither is Loanpal, and this isn't legal advice or meant to be construed as legal advice. It's just information we've derived from industry sources and personal experience through our companies. And as always, we encourage you to seek legal advice as you need from legal counsel. So let's just dive into the history a little bit here about the BSA and AML. You know, it was originally enacted in 1970 as the Bank Secrecy Act, and we call it the BSA. Later on, the USA Patriot Act amended the BSA to require financial institutions to establish AML programs, which we know is referred to as anti-money laundering law. And that's how we refer to it today now, the BSA/AML programs. FinCEN, which is the Financial Crimes Enforcement Network, is the delegated administrator of the BSA AML, an agency that enforces compliance with those laws. So let's just talk a little bit about money laundering. I thought maybe we could have a couple of interesting facts about money laundering. We all can look up the regulations and the requirements, but let's talk about money laundering a little bit. It's the money laundering definition is the criminal practice of processing ill-gotten gains or dirty money through a series of transactions. This way, the funds are cleaned so that they appear to be proceeds from legal activities. And there are 3 independent steps that go through this to have money laundering be effective. Placement, which is the introduction of unlawful proceeds into the financial system. And they try to do that without attracting attention of law enforcement or the financial institutions. The next stage is called layering. The second stage of the money laundering is layering, which is involved moving funds around to create confusion and exonerate the paper trail. And then finally, which is the ultimate goal of money laundering, is called integration. Once the funds are in the financial system and insulated through a layering stage, the integration stage is used to create the appearance of legality and create a plausible explanation for the source of funds. So they try to make it appear that it's all on board and everything's good by accomplishing those 2 previous layering effects. The initial purpose of the anti-money laundering and the BSA with respect to financial institutions was to combat money laundering, but it now includes mortgage fraud. And FinCEN's position on mortgage fraud, that's a crime and often connected with other types of money laundering. As you know, there are lots of civil penalties that can be applied for non-compliance with the BSA and AML. So this is very serious stuff, and I don't mean to make light of it because there are some money penalties, and as if you've read, if you go on the FinCEN website and other, the CFPB, I believe has published also some information. There was a recent civil money penalty that was very large for non-compliance of this law. So it is very serious that these companies, all companies that are required to do so, have a program in place. All entities that are under this rule are required to take reasonable steps to combat money laundering and terrorist financing to minimize vulnerability to the risks associated with these activities. So later on, throughout the history of this law, in April 16th of 2012, FinCEN issued a final rule that included now non-banks or mortgage lenders, that they are now included in the definition of finance or loan companies, and then that required them to establish AML policies and a program and report now under the BSA. So it became not just a bank requirement. When FinCEN came along and amended and issued a final rule, then now it's required of mortgage lenders to report as well. Types of common mortgage fraud may have to do with misrepresentation of identity, straw buyers, income of assets, misrep of occupancy, appraisal fraud, properly flipping, short sale fraud, reverse mortgage fraud, foreclosure, or loan modification fraud. And there are all kinds of new schemes that are in play, changing every day. The agenda that we're going to go over today are these items that we have here on the program. We're going to go over what's required, the main program for the mortgage originators, the suspicious activity reporting, some tidbits on the marijuana industry and how it applies today, some information on elder financial exploitation, FinCEN Form 8300, which is the $10,000 in cash reporting requirement, information sharing, FBARs and CMIRs, and OFAC. I'll start with the 4 pillars of an AML program. The program that the AML requires any mortgage lender that is required under this law, you have to have a program in place with 4 pillars. The program must be in writing, it needs to be approved by your board of directors, and it needs to be reviewed and or updated annually. The main items of the 4 pillars are developing of internal policies and procedures. These procedures need to be based on the company's assessment of money laundering and terrorist financing risks with their products and services. So on the onset, we'll get more into that in a minute, you need to conduct an assessment in the company. The next item is the company needs to designate a compliance officer specifically for their AML program. An ongoing training program for all employees, and an independent audit program to test all of these items in your program. The risk assessment portion needs to be based on 4 items specifically, but it doesn't have to be limited to these 4 items, but these items must be included in your risk assessment. You should document your risk assessment. You should put it in writing that you have completed it on a company level, because we have seen the state agencies and the CFPB and other agencies that govern mortgage lenders and banks come in and ask for the risk assessment. So we have seen that starting to happen, where they're coming in and wanting you to document and show them where you've done this risk assessment. These types of things that you can look for in your company is your size of your company, geographic areas where you are lending. You might consider the high density drug trafficking areas as well as the high-intensity financial crime areas. If you're lending in some of those areas, you want to maybe assess how you're going to handle that and how you're going to protect yourselves against crimes of that nature and fraud. Also, you need to take into consideration the type of products that you offer within your company and the source of the business or the business channel from your loan products.
Wonderful. I'm going to start in on the compliance officer section. So let's talk about this piece of the pillar. So the AML program requires the designation of a principal compliance officer who is responsible for the general implementation of the AML policy within the company. So basically, who's responsible for the program? You want to designate one person to own the system and ensure processes and procedures are followed and updated when needed. Reports are filed timely, that training is correct and completed. You may consider a senior level individual who has the power to influence the company and ensure success of the program. The next item here is the audit item. That's a mouthful. So is everything running smoothly, right? That's the next pillar. One thing to consider is if you're going to do an internal versus an external audit. If you have somebody who is, who's the appropriate person to conduct the audit. If this is managed by a risk department or somebody who conducts the internal audit, you would need an independent party to conduct the audit, so you may need to outsource that as your best solution. So as far as the audit piece, I know examiners are looking for annual audits, and that happens across state examiners and investors and other regulators. As far as the plan and program, we want to make sure that's included in your policy and procedures. So the elements of your AML plan being documented in your policy. This includes all areas above and the 4 pillars of the RMLO AML program. One little tidbit here is that brokers are required to do this as well. I know that sometimes we think of this as being a lender requirement, but it's also something that brokers are required to do. All right, next slide. There we go. The next item would be training. So ongoing, at least annual, training for staff that may help detect and report suspicious activity to the respective parties within the company. So every employee who has contact with customers or transactions needs to understand your company policies and procedures, the legal requirements and the techniques used by money launderers, and then also how to report suspicious activities. Oversight. So typically this would be a compliance officer overseeing the program, and this is key. Fraud departments are also a good resource in order to utilize to review the training materials as well. So sometimes you can have the fraud working with the compliance department, and it's kind of a joint effort. Enforcement and accountability. This is really important. I think that we're seeing this more and more in our industry where who's required to attend the training and what happens if they do not complete it? Do they get an email from senior management? Are their managers kept responsible to ensure that AML training is completed? I have seen in the past where a president sent out an email to all staff who did not complete training on time, and it got completed very quickly after those emails were received. So I think that's something to keep in mind is not just sending out the training, but we need to ensure the training has been completed. This is something that will be reviewed upon an audit. I can tell you that's a piece that sometimes lenders may not be as diligent on. I believe this is for you, Robyn.
Yeah, so the next part included in the program is ongoing monitoring. And the way you can and when you can start your monitoring is not just in your operational area. Obviously, that's going to be the main part of where you're going to see issues or where you will need to monitor. But also there are other methods that you can get your information and other areas in your company. You should be reviewing your quality control resorts. Sometimes there are findings that are related. If you start pulling that string, maybe something looks a little bit off, and the more you pull that string off the ball of yarn, the more you might find that there's something that does require you to file a SAR. So you need to monitor those quality control results, repurchase demands, indemnification requests from your agencies or your private insurers. And then there's a cycle for that's if you kind of just remember to cycle through for monitoring. First, you need to identify the unusual activity. Then you would need to alert management. You make the decision then whether or not to file the SAR. The SAR, if you do file one, the SAR completion is done. You file that, and then you monitor that information, that SAR filing, for any continuing activity. And then you go back again and you would continue to monitor other areas. Pamela?
The next pillar is the Customer Identification Program, otherwise known as KYC. We're going to kind of use this interchangeably. So this first point is really just to make sure that you're aware there are lots of software programs out there to combat financial crime and to avoid trouble. So with the rapid growth of the fintech industry, I think this has led to an increased demand for regulations, especially in fighting financial crimes. So we know anti-money laundering and know your customer are prevalent in the financial world. There's 4 key elements to the program: customer acceptance policy, customer identification procedures, monitoring of transactions, and risk management. Wanted to make sure we're really clear as to the Patriot Act requires a CIP, and we commonly refer to the Know Your Customer or KYC under the AML. So one of the biggest questions on this piece is, how do you validate your borrower? Is it a copy of the borrower's ID? Are we using a system? Are we using a software program to perform a comparison of background data to ensure you're working with your borrower? This should all be documented in your program to be really clear as to how you are satisfying this requirement. Again, how are you documenting this in your loan file? I've seen lenders, in my experience, use the Patriot Act form to complete this documentation in the file, but then the question comes about is when. Do you do it up front? Do you do it at closing? When is this done in your process? Again, the objective of the Know Your Customer guidelines is to prevent lenders and financial institutions from being used intentionally or unintentionally by criminal elements for money laundering activities. The procedures that we set in place enable us to better manage risks in our industry, and it minimizes the risk of fraud by identifying suspicious elements earlier with the client, and hopefully will mitigate the business relationship. So this includes the collection of analysis of basic personal identifiable information, or PII, and then the screening of that identity against global watch lists as well. So let's talk about SARs, suspicious activity reports. So we're all familiar with the basic requirements. I'm going to read through these really quickly, but what you report. So according to FinCEN, the BSA AML examination manual states criminal violations involving insider abuse in any amount, criminal violations aggregating 5,000 or more when a suspect can be identified, criminal violations aggregating 25,000 or more, regardless of a potential suspect, transactions conducted or attempted by or through the bank or an affiliate, and aggregating 5,000 or more if the bank or affiliate knows, suspects, or has a reason to suspect that transaction. It goes into some additional descriptions here. So basically what this comes down to for lenders is, what do you report? As a lender, it's something that I think a company does need to determine and actually have some input from your compliance officer or general counsel as to what is your appropriate duty as to when you need to report situations that come up. And this should be documented in the company policy. I think I've seen some policies that actually went to the level of altered documentation, or actually what specific items they were going to report and when they were going to file a SAR. It's interesting that the FinCEN AML BSA examination manual has a section on SAR decision making. So it talks about, after thorough research and analysis, after it's been completed, the findings are typically forwarded to a final decision maker, an individual or committee. I've seen this in my experience work under a fraud committee, or it may be somebody at a general counsel level who's making that determination. So it kind of depends on what your company is doing. Again, policies and procedures are key for referring this unusual activity as to how information gets sent to that department or individual so that they can evaluate the unusual activity and then make a determination whether or not they're going to be filing the SAR. So it's important that that's designated, which obviously you would need to have the AML compliance officer role be part of that decision making or the decision maker. So when do you report? So reporting is required to be filed through the BSA e-filing system no later than 30 calendar days from the date of the initial detection of facts that may constitute a basis for filing a SAR. In the case where no suspect can be identified, the time period is extended to 60 days. So again, changes happened a few years back where this is all now through the BSA e-filing system. So you want to make sure you're all set up to go file that SAR in that system. And obviously the program would need to determine who reports SARs at your company. So who is the designated person who does that, who completes that that SAR. And I recommend you've got tracking mechanisms in place so that you can track what's being filed and where, so that you can produce that if ever asked by an auditor. So what happens after you file a SAR? I think that's a big question that comes up. People wonder if it gets looked at and if it's actually going to be something of use for the FBI and the government. So the information that I have is that FBI white-collar crime work integrates the analysis of intelligence with investigations of criminal activities such as public corruption, money laundering, corporate fraud, securities, commodities fraud, mortgage fraud, financial institution fraud, bank fraud and embezzlement, and fraud against the government. And that's from the FBI.gov. I know that sometimes there's the thought that, is this one SAR going to make a difference? If they've got lots of SARs that come from various sources, but it all entails the same parties, obviously they're going to identify that there's a bigger scheme going on, and it is going to be useful and something that's going to be very helpful in uncovering a scheme or a large-scale fraud. I wanted to share a couple of examples of some SAR filings. It's really interesting that FinCEN used to have a really in-depth list, and I'm going to share a couple of the headlines that they have in here as to how those SARs actually played a role in uncovering some fraud schemes and some very large cases that were found. So this one is from July of 2014. The FinCEN reported that Bank Secrecy Act records assist in mortgage fraud investigation, resulting in this guilty plea. In a case where as much as $7 million in losses were realized, the Bank Secrecy Act records helped identify co-conspirators, accounts, and elements of the mortgage fraud scheme. So again, those suspicious activities are helpful, and this person, I think, was sentenced to 5 years in prison and $3 million in restitution. So that's always good. Another one was SAR referral leads to discovery of a $100 million mortgage fraud and foreclosure rescue scheme. This one's a little bit older, but again, investigators uncovered a large-scale mortgage fraud scheme that originated from a SAR filed on the subject who actually turned out to be a victim of the fraud scheme. So this is information that is out there on the FinCEN website. If you haven't been there, I do recommend you check it out because there's some information you can even use in your QC world. That's another piece that's available. I did want to share a personal experience that we found here in my lending world. So we had a loan that was referred to the fraud department for review when the underwriter questioned a recent employment and found the borrower was working for a company owned by the real estate agent on this transaction. This agent was then was representing both sides of the purchase, and we discovered that the borrower was also the sister-in-law of the agent. So the underwriter had Googled the real estate agent and found quite a discovery. She was actually under indictment as of last December for her role in financing the purchases of real estate using money laundered from China to create illegal grow houses. So there were 100 homes that were seized, and there was an international scheme that was being carried out right here in Northern California. The relatives of this agent included the spouse and the niece that were also named in this indictment. The agent was keeping the down payments under $50,000, and the loan that had been presented to us recently actually fit the same characteristics. They had a bank statement that had some seasoned funds in the borrower's account of about $36,000. And interesting enough, the borrower had only earned about $22,000 in last year's W-2s. So again, some questions the underwriter had presented, and this case was very similar to one that was part of the indictment, where the realtor's niece had actually purchased one of the homes and was only making $13,000 a year and was working in another state. So we believe that the sister-in-law was being used as a straw buyer to further this enterprise. And again, this is why it's so important that our underwriters are up to date with fraud training. So again, the website I have here as to where you file your SARs, and you take it over now, Robyn. It's all you.
We'll go over this next topic. Just wanted to kind of call your attention. This is kind of controversial still due to the conflict between state and federal law currently. Right now, under federal law, funds derived from the distribution of cannabis is considered money laundering. However, there are 11 states as of June of this year that have legalized marijuana for recreational use, and 33 states have legalized the use of marijuana for medical use. So there's that age-old, do I file, do I not file? There has been guidance from FinCEN in February of 2014 that talk about the different types of SAR reports that you need to file or can be filed on this. There's a limited, a priority, and a termination, and we'll not go into all of that. You can look that up. That is in the guidance that was issued. It's 2014-G001. There is a pending bill right now. It's HR 1595 that will resolve this conflict between the federal and state laws. So we're hoping as an industry that we can get some clarification as it goes on. There are institutions that have decided to file SARs, or that they feel that they should file SARs from employees who are earning income from marijuana related businesses, but there are some that have interpreted that they should not be filing them. So really, it's kind of up to you. You need to determine that within your policy and procedures. And of course, you've probably consulted counsel, and you really need to make that decision internally. We have heard from some of our clients, and then also follow the guidance under CINFIN. We have heard from some of our clients that Fannie Mae may allow income from a W-2 employee as long as that W-2 employee is not an owner of a dispensary. But you should also check that out with your own Fannie Mae rep, and that's just information that we're like to pass it on to you, and confirmation of such. But this is still a controversial issue. Again, conflict between federal and state, and until we get further clarification, I think it's still going to be up in the air as to the gray that exists there. The next area we'd like to talk about briefly is elder financial exploitation. This is an area that's becoming more and more aware in our area. There's been more and more on the rise because elders are being taken advantage of financially. There are some red flags, and the CFPB and FinCEN issued a joint memorandum in August of 2017, and it identified the role of financial institutions that we are supposed to detect, respond, and prevent elder financial exploitation. That's the role and the responsibility, and the emphasis is also on training employees on how to detect this so that they can respond and prevent it as required. Some facts or some red flags that may exist, just a couple of them I'll read here. that maybe should spark a red flag in your institutions, that if you see erratic or unusual banking transactions or banking patterns, if you're not able to speak directly with the elder despite repeated attempts, if there's a new caretaker or friend that suddenly begins conducting financial transactions on their behalf without the elder present, if the elder appears to be reluctant all of a sudden to discuss the matters, or if they lack the knowledge about the transaction, should always validate that if there's someone claiming to be a family member to be putting on the transaction, that you validate that it is in fact a family member who has authority to do so. So this is on the rise, and you should be aware, and you should also make sure that you're filing suspicious activity reports wherever appropriate. The other item that is required under the AML program is, of course, the cash payments of $10,000 or more, over $10,000 received in one transaction or two or more transactions that are related in a 24-hour period. This is probably unlikely that we'll see this in our type of environment, but we need to be aware that there are requirements to file, and it's the FinCEN Form 8300. So this requirement still exists. However, you may not see that unless you get a payoff from someone in a servicing environment or a down payment in cash or some type of a transaction at closing. Very rare, but you need to be aware that there are requirements to file a specific form or forms. And then again, there are requirements as part of the BSA AML program that financial institutions that have an interest or signature authority in any foreign bank account or foreign financial accounts are required to file certain forms as well. And that can be found in the legislation as well. Information sharing, there's information sharing requirements for financial institutions. Anything that comes over from FinCEN will likely be a government that is, or law enforcement agency that is trying to inquire about certain information so that they can be investigating either terrorist activity or money laundering schemes. So those institutions should not be sending any requests directly to the mortgage lender or bank. Those should all be coming to through FinCEN, and then FinCEN sends a request, and then there are items that you have to include to respond. And these should be part of your AML program and procedures, and we've outlined them here. And they're also found, it's section FinCEN 314A, and that's requests coming from federal law enforcement and or agencies coming through FinCEN. And then 314B refers to request, and it's sharing of information with other financial institutions, and this is voluntary. However, if institutions are going to participate in that sharing of information, they must notify FinCEN of their intent to share information. They need to designate a contact person and maintain policies and procedures on how they're going to handle to safeguard the security of that information. If institutions are going to share information with one another, both parties must have filed an annual notice of participation with FinCEN. And that is part of the Patriot Act.
All right. So on OFAC, I wanted to share kind of the history on OFAC, and I had known this has been around a long time, but my goodness, this goes back to the World War II following German invasion of Norway in 1940. So this OFAC has been around a long time. I know that I'm not going to spend a great deal on this background piece, so we can go ahead and move on in light of the time here. So let's go to the next slide. So the implementation of OFAC. So we have utilized in our industry credit bureaus and various agencies to ensure compliance with OFAC. So sometimes our credit reports will identify if we have a match. Sometimes we use a fraud report or various other compliance reports. I wanted to kind of go over what happens when I've seen it when there is a potential match. There may be a red flag or an alert that there may be a match, and Sometimes we can clear those with matching somebody as their date of birth, matching what our borrower is, or sometimes their origin of birth sometimes is provided on OFAC lists, so we can see that information. If you're not able to just clear that as a false positive, in that case, you would need to go out to either the hotline, or you would need to go onto the website and search it to see if you actually have a match on OFAC. I can say in the almost 30 years that I've been in this business, I have not had an actual match. They've been false, and we were able to clear them. Next slide. So monitoring is required, and I think that there's a fair, various ways you can do this. I mentioned the credit report, the fraud report, Ellie Mavent compliant report. But one thing I wanted to point out is that, the credit report only validates our borrowers, where if you have a fraud report in your file, that's going to actually validate all participants in your loan. So you would have your other parties that are involved, and I think that's important. So what is your policy to validate a match? How is the match cleared if false, and who's responsible for documenting this in the loan file? These are all things I think are really important that we address in our policies and procedures on OFAC. This is a reference list, and I just wanted to point out a reference that I thought was kind of interesting. At the very top here for AML, there's an Association of Certified Anti-Money Laundering Specialists, or ACAMS. This is an association that helps connect others. There's forums and there's local chapters for this group. It can enhance your knowledge and your skills. They offer trainings, webinars, and full-day seminars, and even live chats. But they also can help you establish your expertise. They offer a certified anti-money laundering specialist credential, and did not realize that was out there. So I thought I wanted to share that link as a really good source. They have some good resources out there. Anything else that we wanted to cover or point out? I think this is just some general references for anybody who would like them on the various topics.
Right, and we'll turn that back over to you, Monica, or for any questions.
Great, thank you so much, ladies. Very well done. Susan, do we have any questions in the queue that you would like to share?
Yeah, let me see here. I'm sorry, I'm having trouble undocking this to take a look. Here we go. Okay. How should we view the Social Security number fraud when someone who was using a fraudulent Social Security number and then was able to obtain their own Social Security number later? HUD seems to allow it when someone was initially here illegally and then got their residency.
I can speak to this one. I have actually seen problems with this come up. I had a loan come through with a borrower with 4 socials, and this person had several socials that they had purchased and then actually got a legitimate social. The problem you're going to run into is that they could have had bad credit on any of those socials, and if you pull the credit report only on the very final validated social, you may be missing some things that happened in their past that are not going to show up on that credit report. So in my situation, there was actually like a repossession on one of the previous socials, and some really bad negative credit that had appeared. So I would be careful about that situation.
Okay. That is the only other question that I have relative to the content. There was a couple of questions regarding those slide decks. We don't send out the slide decks, as I've indicated in the chat section. However, we do have the recorded webinar available on our website, so we'll probably have that up, if not by tomorrow, definitely by Monday. I think that might be the last of the questions. I want to thank our speakers today for participating. I think we had a fantastic set of information that was shared, and very important information. So thank you, Robyn, and thank you, Pamela. We do not have a MCLAC webinar in August, but we do resume again in September, and Pamela will be back in September talking about the internal audit function and your CMS. You can mark your calendar for September 26th to hear that presentation. That concludes today's webinar, and thank you very much for your time, and I hope you have a great day.
Thank you, everyone.
Thank you.